Oh, it's that time again. It is time for another very exciting edition of Market Takes. I'm your host, Dion Rabowen. I know you could have been anywhere in the world, but you're here with me, and I thank you for that. Look, we are diving in today to the November non-farm payrolls report, the jobs report for you plebes out there. And this was a very interesting report. We have seen a significant market reaction. We're looking at the stock market, the futures market, S&P, NASDAQ, Dow futures, all moving pretty significantly after the release of this report. We're going to get into all that, tell you what the moves mean and why. Also looking around markets, I'm looking at, dollar currency market. We're seeing bond markets move in some very interesting ways. It's not quite one linear move, but we're going to break down all of that as well as get into just what the report says, talk about what some of the most important numbers are, maybe some of the things that you're not seeing in those headlines out there. We're going to be talking about all that. So thank you very much for being with us here on Market Takes. So look, we're going to talk about what the headline numbers were, obviously how many jobs the U.S. economy added last month, as well as the unemployment percentage or the unemployment rate. We're going to talk about how those numbers compared to expectations, because we know these numbers aren't just in a vacuum. Everything is all about expectations, and most importantly, how these impacted the Federal Reserve's expectations and those of Fed Chair Jerome Powell. We're going to talk about some of the most important numbers in this report, like I said, and how those relate to recession fears and inflation expectations, what we can discern looking forward for the future of inflation and what we expect the Fed to take from this report about inflation. Of course, like I said, we're also going to talk about how the markets reacted, and we're going to talk about what to look for going forward. I'm going to tell you all that. So look, no more talking just about air. We're going to get into the numbers. I know that's why you're here, because you all love the numbers. The headline numbers: the U.S. economy added 263,000 jobs in November. The unemployment rate unchanged at 3.7%. Unemployment rate has really been in that range at 3.5% to 3.7% most of the year. So not a big move there. And again, this month really unchanged from the previous month. Now, that 263,000 jobs is more than expected. And we're showing that not only are the job gains not slowing, as we'd seen this consistent slowing pattern for most of the year, we're actually picking back up. And so that could be one reason that we're seeing the market reaction that we are this morning. Now, a key piece of data was just that, again, we'd seen that trend cooling. You'd seen declining job numbers really since July. This was the first time that we actually saw an increase in the number of jobs from the previous month, and that's not a sign that the Fed wants to see, or at least the market is interpreting it as not something the Fed wants to see. That's something that I think is why you're seeing stock prices down right now, bond yields up, but again, we'll get into all that in just a minute. So the expectation was for 200,000 jobs. We got 263,000 jobs. So not a huge overshot in terms of the number, but like I said, we're moving back towards that 300,000 number. And actually, when you look at the trend, you're seeing now 282,000 jobs as the 3-month average. That is well above the average that we saw in 2019 when you want to go back pre-pandemic. Back in 2019, we still had a strong economy when folks were adding jobs consistently. It was only 164,000 3-month average at the end of the year. So we're well above that pace by more than 100,000 more jobs added. And again, when it comes to the Federal Reserve trying to slow the economy down and saying, okay, we can't stop raising rates, we can't stop choking off and making the economy tight until we see these things slow down, that's not positive for markets. Certainly a good thing for the economy, certainly a good thing for job seekers out there, folks trying to get a raise, folks trying to get a job. But for the Federal Reserve, this is not a great report. And for the market, well, if you're a stock investor and you're long the market, this is not a great report for you. Want to talk really quickly about the JOLTS report, Job Openings and Labor Turnover Survey, that we had come out just earlier this week or last week. That showed that there were still 10.3 million job openings in October. That's down from 10.7 million the month before. You still got 6 million hires in October. That's down 84,000 from September. 5.7 million separations. That's also down from September. But the difference between hires and separations was about 329,000. All that means, the only reason I'm telling you that, is that was well above the 260,000 jobs added from the non-farm payrolls report. So we saw in October JOLTS report said more jobs were added than the payrolls report showed. Then we get this month, more jobs added than expected. And what that contributes to is a sense that, okay, the job market, the hiring market is not slowing down as the Federal Reserve has said they'd like to see. Remember, this isn't just conjecture. Fed Chair Jerome Powell was out here just this week saying, you know what, too many job openings, job growth moving too fast, wages rising too high. These are things that we need to see come down and cool off before we can stop doing what we're doing, which is raising interest rates and choking off the economy. So that's why you're seeing, I think, a negative reaction from the markets. Also important to note, the quit rate fell in October. So you're seeing less people quitting, more people hiring, and that's not a sign for inflation slowing down, because as less people quit, well, you got more competition for these jobs. That means employers have to raise the rates that they pay, means more people get raises, means more money flowing through the economy, more spending going on. That's generally a good thing for the economy, but not when you've got inflation near 40-year highs. And that's what this is all about. So the Fed has said very clearly, we are watching this JOLTS number, we are watching the jobs market, because that's going to give us a sign that inflation is cooling, and we're not seeing the job market cool down. Still seeing 1.7 job openings for every unemployed person from the JOLTS report, and Fed Chair Jerome Powell mentioned that very specifically in his Brookings speech just this week on Wednesday. So definitely keep that in mind. The markets are responding to Fed talk because the Fed is really the only thing that matters. Look, if you're not watching inflation and you're not watching the Fed, you shouldn't even be in the market right now. You shouldn't be investing. Close your account, go look for Pokemon. This is really the trade right now, and so everything is all about what the Fed is doing and what they're saying and speaking to the market, and how the market interprets this data in terms of what the Federal Reserve is going to do next. So looking back at the trend has been jobs lower consistently each month. We had 687,000 or 678,000 jobs added in February, and we've kind of seen a consistent downward trend since then. In July, you saw that last time the jobs report really picked back up, and then we've been kind of consistently moving down since then. We have bucked that trend now, and the worry is that we are going to keep moving back up higher, adding too many jobs, which somehow is bad for the stock market, like I said, like I just explained. Look, probably the most important number in this report that maybe isn't getting a lot of play in those headlines is average hourly earnings. The month-over-month number rose by 0.6%. That doesn't sound like a lot, but that is double the expectations. Economists had expected average hourly earnings to pick up by 0.3%, and we got an additional 0.6% pickup in average hourly earnings. The year-over-year number is still about 5.1%. That hasn't moved too much, but it was kind of declining towards that 4% number, now picking back up towards 5%. And that means, again, as average hourly earnings rise, more people have more money, they're spending. The Fed isn't able to choke off the economy as effectively if people continue to have money that they can go out and spend, keep buying, companies keep raising those prices, Americans still able to pay it. What the Fed wants is to beat the economy down and make it so folks just say, hey, you know what, I'm not going to go out and spend, I'm not going to borrow money to pay for these things, I'm not going to try to expand my business, I just want to sit tight and not expand the economy by going out and doing what I do. That is not what we're seeing from this report. So as we look out at the overall environment, we're looking at the market, this report has likely cooled off some inflation expectations, in the idea that inflation expectations had been falling consistently. We're likely to see a cool down of that and maybe see inflation expectations kind of hold pat. They've been, investors, if you look at the 10-year, the 5-year, those break-even inflation rates, which show what investors are betting on for the economy, we have seen kind of a consistent come down, but not a drop off the cliff. We haven't seen inflation expectations move meaningfully back toward the Fed's 2% target, and that's what the Federal Reserve wants. They want inflation expectations anchored, meaning held down right around that 2%. We're seeing 5-year inflation expectations up closer to 2.5%, about 2.45% as of yesterday, and even 10-year inflation expectations right around 2.4%. Not high, it's not much higher than 2%, but it's significantly higher if you look at the historical long-term average. So that, again, is what the market is saying. It's seeing these numbers and saying, hey, you know what? We don't think the Federal Reserve is going to be done. They may have to hold rates higher for longer, raise higher than we expected, and that's going to do more longer-term damage to the economy. And like I said, it's right now things are good. You're seeing hiring continue. You're seeing average hourly earnings rise. Don't forget, still below inflation. So real earnings are still negative because we're well below the rate of inflation, but the trend is not our friend when it comes to those sorts of things. So that wage growth number at 0.6%, probably the most important number in this report. Like I said, that a lot of folks really aren't talking about right now. Look, the other thing is that jobs added number. And one thing that an economist pointed out this morning I thought was very interesting was we're seeing people, especially here in the US, run through their excess savings. You had $2.5 trillion of excess savings raised through the pandemic kind of at the start of this year. Now that level may be down to about $1 trillion. And that's, again, overall throughout the economy. Most of that is at the higher wage levels. Those lower wage earners, those folks at the bottom end of the income spectrum, have a lot less, and a lot of them are expected to be getting pushed back into the workforce. But here's the other very important number from this report that maybe you're not hearing talked about in the headlines. Labor force participation declined again. We saw labor force participation drop to 62.1%. It has declined every month since August. You want that number picking up because when there's more competition for jobs, you've got employers able to hire more people, be more selective. They can have a little bit more room to say, you know what, you're not getting a 5% wage, we're giving you a 3% wage. That's not great for workers. It's not great for you and I, but it's what the Federal Reserve wants because they need to cool down inflation. So this labor force participation rate, that broadly is negative no matter what's happening. When it's going down, we're seeing that decline, and that could again contribute to inflation picking up and again those negative outcomes for the Federal Reserve. So likely recession fears a little bit cooled off by this because if people are still adding folks to the work rolls, if people are still adding folks to the job rolls, it's hard to really have a recession when lots of people have jobs. One thing that I've been talking about with folks is, could you have a recession where you've still got this under 4% unemployment? People still have their jobs, but they just can't afford things because inflation is so high. That's one thing to keep your eye on. But as we think about the traditional ideas of a recession, this jobs report certainly kind of pushes that off back to the back burner. So we're going to check out WSJ.com right now, talk about how markets are reacting. Like I said, the stock market, stock futures really sold off before the market opened up. And we had this report out at 8:30 this morning. You saw the Dow really just jump off a cliff, the NASDAQ, the S&P 500, all lower by significant numbers. And we are still seeing markets now that the market is opened. We're still seeing the Dow, the S&P, the NASDAQ all down. The S&P 500 down by a little more than 1%. NASDAQ down by about 1.3%. So it'll be interesting to see what happens throughout the day because you saw a significant decline, precipitous decline really right after the report came out. And then we kind of came back up and now we've kind of come back down. So investors really trying to make up their minds on how bearish is this for the outlook for the stock market. A really interesting response I saw from the bond market because bond yields really jumped up, especially on those longer dated yields, 10s and 30 years, and then came right back down. One thing I wanted to talk about before I forget, the stock market has been on a tear over the past 2 months, the Dow especially. The Dow was up 4% in November and up 20.4% in the last 2 months. That is the biggest increase for the Dow Jones Industrial Average since 1938. Now, the Dow is still down by 4% year to date, about 4.8%, but with the strong gains that we've been seeing on some of the data, and I'm going to tell you about what data reports are coming up over the next 2 weeks or so that could again push this over, we could see the Dow go positive by the end of the year, which would be crazy given how low we've been, and especially crazy given how low the NASDAQ still is. The NASDAQ was up 4.4% in November, but it's been down 8 of the last 11 months, and is still down about 30% year to date. So the NASDAQ is down about 30%. The Dow might end the year positive. That is a huge, huge difference. And it's because those high-flying tech companies are really just getting beaten down by these Fed interest rate hikes. The more it costs to borrow money, the more the market punishes those tech companies that don't make a lot of profit, and even the ones that do, because again, their profits out into the future are looking less rosy when you've got higher interest rates. The future growth is something that investors really, they don't want to pay for. They want growth now. They want companies that turn profits now, and a lot of those are in the Dow, and that's why you're seeing this chasm really of difference between the Dow and the NASDAQ. As it comes to returns. Look, as I talked about, bonds picked back up. You saw a big jump in the 10-year, the 30-year, kind of across the board, and now you've kind of come back lower. Market's really kind of reversing a lot of that big sell-off that you saw because maybe, okay, maybe this isn't so bad. Maybe this doesn't mean that inflation's going to pick back up and continue growing. 263,000 jobs added, not that much higher than 200,000, still well below 300,000, still kind of keeping with the trend of, okay, folks are hiring, but they're not hiring these big 500,000 numbers, things like that. So you saw bond yields really tick up, and they are still up really when you look across the board from the 3-month all the way up to the 30-year bond. But we're seeing a reversal of that. Watch that today because it's interesting to see what the bond market makes of this report. As we look out at the currency market, the dollar had a similar reaction. You saw the value of the dollar really spike up after this report, and some of that is coming back off. Investors starting to rethink how much this really means for the fate of growth or for the trajectory of growth moving forward. That's a big thing. We saw the crypto market really holding steady. Crypto's got its own issues right now. Bitcoin, Ethereum holding right about flat. Ethereum up by about 0.4%, but not a big move. And as we look at it, commodities, crude futures are up by almost 1%. We're seeing gold down by almost 1%. Silver down, really natural gas down by almost 3%. Definitely something to watch, but a lot of those are idiosyncratic issues not moving a lot based on this jobs report. Look, we're going to get out of here, but I thank you again for joining us here on Market Takes. Really quickly, here's what you need to be looking out for next, because like I said, the market has been wild over the past few weeks, and you're going to want to be aware and alert for these next few reports. On Monday, we've got U.S. Services PMI. I don't talk a lot about the PMI, Purchasing Managers Index, but the PMIs lately have been absolutely awful. This week, we got the lowest report on U.S. manufacturing and services PMI since 2020. We got another bad report from Chicago. The Midwest is doing horribly, the worst since 2020, back in the pandemic days. So you're going to have this big report on Monday, U.S. Services PMI, Global Services PMI, and the ISM's report on business services, as well as the Employment Trends Index. You're going to want to watch for those on Monday. That could be a big market-moving day. On Wednesday, we get U.S. consumer credit. That has been extremely high all year. I want to read you a little quote here from Matthew Schultz. He is the chief credit analyst for LendingTree. He says, quote, "In normal economic times, this would be a huge jump. We saw $25.3 billion of consumer credit added. That would normally be a huge jump. However, it is actually the second smallest increase in the past year. Consumer credit has been huge. There's been a lot of borrowing, a lot of people putting things on credit rather than buying them outright. That's something you definitely need to watch for. Friday, of course, PPI, the Producer Price Index. That's big for inflation. On Tuesday, the Consumer Price Index. If we get another low report, you could see markets really take off. If you get a higher than expected report, you could see a massive sell-off. CPI is going to be huge this week. And then the very next day, on Wednesday, we will be right here on Market Takes breaking down what we hear from the Federal Reserve and Fed Chair Jerome Powell at their press conference on Wednesday, December 14th. So thank you very much for being with us. That's going to do it for us here on Market Takes. We will be right here. I'm taking next week off. I'm going on a little vacation, but we'll be right back here on December 14th. Hope to see you then right here on Market Takes.